Federal. Y para ello contamos con Edward Moya, es Chief Market Strategist at Marketpulse and OANDA. Edward, thank you so much for having us a few minutes. It's a pleasure.
Thank you for having me.
Edward, we've known the US GDP, the last estimate. We see how it stays unchanged at minus 0.6% for 2 quarters. So are we in a technical recession in the US?
Well, I think when you take a look at all the data, there's a lot of surprising numbers that we're getting. There was expectations that the U.S. final reading was going to be upwardly revised. That did not happen. You see, personal consumption came in much better than expected. So there's two. It seems like we live in two economies. You have one part where the housing sector, consumer goods, that part of the economy is in a recession. But the rest, the services, is clearly not. And that's really complicating what the Fed will have to do as far as fighting inflation. And I think it goes to show you that this economy has a lot of resilience. And while we do have 2 confirmed negative quarters of growth here, there's expectations that you're going to see a rebound next quarter, and that eventually, I think, at some point in the later part of next year, there's a risk that we could have a severe recession in the U.S. So growth is slowing, the economy is weakening, but not fast enough to slow the Fed.
In fact, Bullard from the Fed, he said we are at a higher risk of recession, but that is not the base case at this time for us. So the Federal Reserve doesn't see a recession in this moment. He said that the Fed will achieve the 2% inflation target in a reasonable time frame. Which could be this reasonable time frame?
Well, I think, Fed Bullard, he is, partially optimistic, and I think in his role you have to be. But there's too many global market risks. There's too much uncertainty as far as how long-lasting this inflation will be, and I think what you're going to see is, the Fed needs to deliver this round of tightening. This rate hiking cycle needs to be in place, and the Fed has to show that they expect it to be effective and that it's going to work. And if the Fed starts to signal they're concerned about recessions, then that is going to make their monetary policy less effective. You're going to see the markets start to rush to expect a rate cut at some point earlier next year, and that's not what the Fed's going to do. So the Fed is no one in the Fed should say they're expecting a recession, even though the risks are extremely elevated. And I'd even go as far as saying the risks of a severe recession are now on the table. So I think you're probably going to see the Fed will probably change their tune after a few more months, and we'll see, did inflation come down significantly? Is the interest rate above where core PCE is? And I'm guessing that's not going to be the case.
Bostic from the Fed too backs 75 basis point hike in November and a smaller rise in December. Is, Edward, this the more likely scenario?
That's the scenario I have in place too. I think that Bostic is one of the more aggressive members as far as calling for rate hikes, and I think what you're going to see, that given the strength in the service sector, given the personal consumption data, given the trend that we've seen jobless claims, that's surprised everyone. This economy is still showing large parts of strength. So I think you can easily make the argument that they should deliver a 75 basis point rate hike again. And I think that's going to take us to a level where monetary policy is clearly restrictive, and it's going to start having its impact on the economy. So I think a downshift after of 75 increase in November is likely, and given the global market risks out there, I think you could easily justify a downshift in December to 50 or 25.
If we consider the current market scenario, which investment opportunities do you see in this moment?
Well, I think undeniably the move in the the treasury markets has really surprised many, and I think that we a month ago, no one expected, the gilts market could potentially crash, and it seems that inflation is going to remain the key story. We have a hurricane that is going to have just deliver another wave of inflationary pressures over these next few months. I think that you're probably going to see. Um, I think this market is going to see short end yields continue to rise. So investors that don't want to hold cash, if they're putting into 1 or 3 month investments that are offering you a 4% yield, that looks pretty attractive right now. I think the market is still vulnerable to selling pressure here. I think that eventually, if we see another 5% lower in equities, then I think you're probably going to gravitate to some of the more the more recent traditional safe haven plays, which might be getting into companies like Apple or even Alphabet, that are going to probably um, have a stronger recovery once this recession is real and fully priced in. I think overall, though, consumer stocks are going to be taking the big hits, so I'd probably shy away from those. And while energy has been the outperformer throughout most of the pandemic, I think that you're still going to see they're going to be able to defend their dividends. They're going to still have good margins. So energy stocks are still probably going to outperform as well. But I think this is the moment where you're not aggressively, if you're in cash, you're not aggressively going into equities just yet. I think there's still risks for short-term downside, but I think that once we have a strong handle on how high the Fed is going to take rates, and I think we'll know that by slightly before the November meeting. Then that's probably going to be when you'll be able to be a little bit more aggressive in getting back into equities. But I think that these next few weeks are going to be extremely volatile, and you should be prepared to buy if we do have any significant stretches where equities drop 5% or more.
This is Edward Moya from OANDA. Thank you so much.